So the big aim is to say we can use financial data that we've got around companies to compare different elements. For example, we can compare how much profit a company is making for a certain amount of sales. And of course, the greater the profit for an amount of sales, the better. So there are a number of these, 5 that we're going to look at that can give us some information about businesses, and we're also going to look at the sort of decisions we can make. We're going to use these figures, and I've put them in each slide. And this is what you would see in an exam. So this is a company, you've got sales, you've got their gross profit, their net profit, their owner's equity, assets, liabilities, equities, current assets and current liabilities. We're going to look at some of the things we can do with all of these over time. Now, if you want to keep a track of them, they are in each slide, so you don't have to remember them or write them down. So here's the first one, gross profit ratio. So this is calculated, you take the gross profit figure, divide it by sales and multiply by 100 to give you a percentage. So if we have a look at what we've got there, in 2013 the gross profit was $320,000. In 2014 it was $315,000. So we can do the sum. We plug those numbers in, we use our calculator and we find the gross profit in 2013 was 32% and 2014 was 26%. So the higher the better. That's the basic rule of thumb here, and this is a ratio where I'm likely to give you an industry average. Let's say the industry average is 20%. We can say 2 things then about these figures. One is it's better than the industry average, and that is a good thing. The second is, though, between 2013 and 2014, gross profit decreased. That's not such a good thing. The way you can increase gross profit is you either increase the price you sell things for or you buy them from your suppliers at a lower price. You get some sort of a discount there. That's the first of the 5 financial ratios. That gives you a bit of information. The second one, the net profit ratio. So not dissimilar from gross profit, you just take net profit divided by sales, multiply by 100. In this case, net profit was $50,000 in 2013 and $55,000 in 2014. So we can do those calculations. 5% was your net profit in 2013 and 4.6% in 2014. Now, in this case, let's assume, I'm going to tell you that the industry average for this business was 12%. So we could make the comment there that net profit is significantly below the industry average, which is not a good thing. And it's also decreasing, which is not a good thing. Net profit takes into account all the costs of the business, whereas gross profit doesn't. Gross profit just takes into account the cost of things we're selling. Net profit takes into account all the costs in the business. So it would tell us that we need to think about finding a way to decrease our business costs. That might be things like paying less for our rent, looking at how much wages we're paying, are we paying too much for power? That's ratio 2. This next one is very important, return on owner's equity. And what this tells us is what sort of return the owner is getting on their investment in the business. And we want to compare it to things in the real world. I've said there that a long-term rate of return from cash is about 6% a year. So you can take your money and you can put it in a cash account and get 6% interest. Well, we want to make sure if we're running a risky business that we're getting a whole lot more than that. Same as investing in shares is 12%. Josie?
Is owner's investment the same as owner's equity?
Yeah, that's right. I've just used the term that they've used in the textbook. Okay, here they've used the term return on owner's investment. So what you're going to do here is calculate net profit divided by owner's equity. So I will use the term we've used in the table. Net profit divided by owner's equity times 100. When we calculate that for 2013, we just find our numbers here, right? So we say, well, here's our net profit figure for 2013. Here is our owner's equity. Divide those, multiply by 100. It's 22% and 24%. Higher is going to be better. So in this case, we said you can put your money in cash and get a risk-free return, or like a reliable return of 6%. You put your money in the share market, the average return is 12%, but shares go up and down, so it's not as easy an investment. And a lot of people will say that if you're running something as risky as a small business, you need to get a return higher than that, so 15% or better. Well, in this case, they're getting 20 and 24%, so that's great. That's a high enough return that they're getting well rewarded for the money they've invested in the business. And the second part of that is saying, okay, it's increasing as well. The trend is increasing, and they're getting a nice return for the money they've invested in the business. Financial ratio 4. This is about gearing, about a business borrowing money to invest with. Because it's not good for a business. If they've got too much money that they've borrowed, that's a lot of interest they've got to pay off for that loan, and if there's too much interest, the business might fail. They won't have enough money to do this. So this looks at comparing total liabilities, borrowed money, divided by total equities. So in this case, in 2013, we can see that total liabilities is $22,000. In 2014, it's $18,000, compared to 105 and 111. So it's 21% and 16%. Lower is better for this ratio. Lower is better. You want less borrowed money, generally. Do remember, though, you've got that idea of over and under capitalisation. Right? So if there's just a whole lot of the owner's money in there, maybe they'd be better off borrowing some money and taking some money out of the business. Don't get too worried about that, but that's more of a subtle thing. That's more of a next level of thinking. Less than 50% is considered a manageable gearing ratio. In this case, gearing ratio is pretty low. It's 21% falling to 16%, so the trend is good. And compared to the benchmark, pretty nice too. Last one is your current ratio. Your current ratio. It is not a percentage, right? So I've just hidden it with the graph down the right-hand side, but in the brackets there I've got it's not a percentage. You just divide one by the other. Current assets in 2013, $55,000. Current liabilities are $22,000. Now, these are the assets and liabilities. Remembering, assets are the things that a business owns. Liabilities are the things the business owes. These now, for current, means short-term, things that are immediately available or have to be paid quickly. So in this case, you're just taking those current ones to see if you've got enough assets to pay your liabilities. And in this case, it's 2.5 and 2.75. A ratio of higher than 2 is considered good. So in this case, we would say that the ratio is increasing. That's a good thing, and it's higher than 2. So they are the 5 ratios that I want you guys to be able to use come the exam to analyse our business.